A scary and rare thing just happened in the markets and could be an early warning signal of a crypto market collapse. Is the bear market arriving early? And should you start selling your crypto, whether it's Bitcoin, Ethereum, XRP, or Solana? Be sure to watch this video before you do anything with your portfolio. And stay tuned through to the end of this video because we'll be covering everything from the crypto market, obviously, but also more importantly, the Fed and how its policies will shape crypto, and that one indicator that I just noticed that could spell the end of this bull run. Okay, so over the last week, as you can see here, we actually lost a staggering $230 billion off the crypto market. If I just take this tool right here and drag it from the top of this range here, which was really just the recent top on Bitcoin, upwards of $70,000, you can see here that we're down currently $215 billion. And at one point in time, we were down over $233 billion. Okay, and I understand that it might be hard to fathom the type of money this is because the word billion has become all too common these days and tossed around, right? But it's the equivalent of the total net worth, okay, of the richest recorded man on earth at $212 billion, which is Elon Musk. And this guy can do basically whatever the hell he wants at any point in time. Okay, $212 billion is basically enough to buy yourself $150 million yachts. Okay, you could probably pick this guy, the Tillman Fertitta, right here, a super yacht, and you could get 1,400 of these things, or you could simply buy out the entirety of McDonald's. Okay, McDonald's is sitting at a market cap of $182 billion. And after having bought, okay, McDonald's, you would still have enough money left over to buy yourselves 2 cheeseburgers daily. Okay, and this is double cheeseburgers, by the way, at $4 on average per pop for the next 9.85 million years. So really, what caused all the recent market sell-off over the past week? Well, if you haven't been paying attention, okay, Jerome Powell at the Federal Reserve, they recently had a meeting of the FOMC. And at this meeting, okay, people were a little bit worried because typically you don't get all 3 of these things aligning on the same day. You don't get the CPI, the core CPI year over year on the same day that you get the Fed interest rate decision, at the same time getting an FOMC statement. So in general, people were worried moving into that, considering the interest rates, and as you can see here, have consistently been hanging out, and I'll just pull that up right here. Sure. Okay. Have been consistently hanging out right here at 5.5%. Now, when you think about how high that is, okay, it is actually the highest rate that we've seen since back in 2000 during the .com crash and collapse. And arguably, we've been remaining at a terminal interest rate for a period of 10 months, okay, or 336 days. The last time we remained that high for that long, okay, we were at a period of 14 bars back in 2006 to 2007 before the collapse that followed, which was considered the Great Recession, right? The housing bubble. And so on that note, the crash and collapse actually happened after they started lowering interest rates. And since we've been terminal, right, it's more likely that they're going to lower rates in order to respond to a crash. The same thing actually happened here. We kept rates terminal right here in 2018 through 2019 for, I believe, a period of 6 months. Okay. And then they actually started to lower interest rates in response right here to near zero to the COVID pandemic. So what's going to bring these interest rates down for Jerome Powell and the Fed? Well, it's likely going to be a market collapse and nothing before then. And so if we hop on over here to this article, you can see here that a sell-off in cryptocurrencies, high growth stocks, and other high-flying assets might be signaling a more cautious outlook among market participants after a stretch of rampant exuberance, investors and analysts said. To continue, few believe that the bull run run that broader US stock markets have experienced over the past year is set for a reversal. Still, concerns are growing that a looming rise in inflation combined with the potential peak in the US economic growth would force investors to cut down on risk in their portfolios. So that said, okay, if we come over here and now look at inflation, it's actually been relatively flat. And recently the last reading, which is not showing up here, was at about 3.3% year over year. But the Fed remains committed to their target of 2%. And so as long as we remain up here, okay, and the projection remains relatively high, and actually their projection is for 2026 to bring that down, it likely means that as credit markets tighten, okay, and as money becomes more difficult to get a hold of, as more companies go bankrupt, as spending slows down, and as you can see here, if we come back to the economic calendar, okay, our crude oil inventories actually increased tremendously to 3.7 million. Typically in the summers, people are driving more and spending more because they're doing more on summer vacation. This time around, the demand simply didn't meet the supply. So they're producing just as much oil, but the supply actually increased in terms of what they had. Why? Because the demand was down. So right here, as you can see here, the Energy Information Administration crude oil inventories measures the weekly change in the number of barrels of commercial crude oil held by U.S. firms. The level of inventories influences the price of petroleum products, which can have an impact on inflation. If the increase in crude oil inventories is more than expected, it implies weaker demand. Important to note, right? Weaker demand, and is bearish for crude prices. Why is that? Well, simply put, people aren't spending as much money on gas. Okay, the same can be said if a decline in inventories is less than expected. So that being said, this is actually starting to look relatively bearish. Now, it doesn't help that if we go over and check out the Bitcoin chart, that upon the news, okay, of interest rates remaining the same and inflation just ticking down by 0.1%, okay, the market, and I'll even go down to a 4-hour time frame, actually started pumping. Now, I don't know why that is, okay, but as you can see here, this was the bottom on that Tuesday, and then the market climbed pretty heavily on June 12th, on Wednesday, only to be sold right back off into this range here. Now we're seeing a slight support here, but if the market starts to break down below that $67,000 level, you better watch out. Now, for that scary, sneaky indicator that could spell the end of this bull market, what is it, right? Well, typically, if you didn't already know, Bitcoin and the S&P 500 trade in unison, okay? There is a positive correlation between the two. Why? Because they're considered risk-on assets. Okay, that typically means that it's more risky to hold in an environment that might be slightly more bearish, and so asset managers, portfolio managers, people like me and you typically don't want to hold that volatility through a potential bearish move. So what they do is sell those assets to hold things like the dollar, which means the dollar is typically negatively correlated. So if I go over here and just pull up a chart of the S&P 500, we'll just do that index, you can see that in general, they trade relatively in union when one is going up. And yes, by the way, the S&P 500 does actually trade far less more volatile. It's still more volatile than most assets that managers want to hold. Okay, typically when the S&P 500 is going up, Bitcoin is going up. When Bitcoin is dumping, right, in this range here, right, so is the S&P. And you can even see here that in the peaks and troughs, right here and here, right, they're both kind of following in similar fashion. So right here, you can see that Bitcoin starts to climb, right here, you can see that Bitcoin starts to dump. By the way, this chart right up top is Bitcoin. This orange line is the S&P 500. But at one point in time recently, as you can see here, Bitcoin starts to dump while the S&P starts to pump. Okay, so what I'm going to do is I'm going to pull these charts up side by side against the dollar. And we're going to start to notice something. So on the left hand side here, we have the S&P 500. In the middle, we have Bitcoin. And on the right, we have the dollar index. Now, the first thing I want to make mention of is we're just going to go ahead and look at this previous high at $71,980. And by the way, wherever that middle crosshair aligns in wherever my mouse is, you can see on the left hand side and on the right hand side, it's showing the same exact time frame. So right around here, okay, which would denote this range right here on the dollar, you can see that Bitcoin started declining. While at the same time on the dollar started inclining with, obviously some volatility right there, but we're going to delete that. In general, the dollar is now going up from this range of 103. It's currently sitting at 105, while Bitcoin went down from a range of 71,900 to $66,000 right here. 66,900 technically. Okay. And so that said, they are negatively correlated. When one goes up, the other goes down. It's a pretty basic math, and it typically is an indicator that as people are selling Bitcoin, they want to hold dollars, right? Why? It's less volatile, even if there is inflation, because while Bitcoin can collapse, I don't know, 20% in a single, week, the dollar isn't going to experience 20% inflation in that same week. So they still want to hold the dollar. Well, what's super interesting here is from this range right here, if I'm lining it up properly, right here, you can see that this product right here, the S&P 500, was trading at around 53 and has actually continued to climb in the same time frame. So typically the S&P 500 and Bitcoin trade very correlated, right? They are both considered risk on assets, which means typically if the S&P 500 is up, then Bitcoin should likely be up. But for whatever reason, Bitcoin is down while the S&P 500 is up, which means there's currently a negative correlation between 1 and 2. And this is what's worrisome, because this right here is typically the right indicator. You have the US dollar goes up while Bitcoin goes down and the S&P goes down. So what does this mean? It means that there is something off in the market. Right now, these two are normally correlated and they're not. And I'm not saying that anything can't and will happen in the markets. I'm saying that one of them is likely wrong. So what is it, right? And I'm going to get to that point here in a second. So either the S&P 500 is trapping people at these highs, and yesterday's, a couple days ago, the previous gap up is an exhaustion pump, which will continue for maybe a short while before breaking down hard, or Bitcoin is currently undervalued here, okay, and is likely might experience one last little wick or move to the downside right here before coming back up into a real range and then following suit with the S&P. As it climbs, it will also climb as the dollar starts to fall. That's typically what happens in these types of markets. So Bitcoin is either currently undervalued and is being sold off due to leverage from retail and whales and suppressing price so they can accumulate a bit more Bitcoin into the breakout. Then both Bitcoin and the stock market continue their climbs higher. But my biggest concern, and here is the point, let me go ahead and remove all these drawings and go back to my. So if I pull up an indicator on the S&P 500, we're going to go ahead and just pull up that RSI. Okay. And typically I like to, let's move that down, and let's get that out of the way. And then I'm going to change a setting on the RSI. I'm just going to get rid of that MA. Okay. As you can see here, that the S&P 500 has consistently been printing new highs. Okay. And I can pull up the volume, but I'm not going to do that right now. So what we're going to focus on is this RSI. This was our first major peak, right, into a strong move from its low at $4,000 all the way up to about $4,800, which is actually well above that previous all-time high right here. Okay. And as you can see here, that we've just consistently been making lower highs and lower lows on the RSI, while on the price or the chart, we've been making higher highs and higher lows. So what this means is, and I'll just circle this out for you right here. Okay. Then the next major peak, maybe even just, well, heck, even right here. Okay. At these 2 points right here and here, This right here, this breakout is actually weaker, even though, right, we're starting to break into new highs right here. This high is weaker than this high. There's less momentum, okay? There is less breadth and depth and strength in all of these moves over here than there were over here, which means one thing. We have been, since December of 2023, in a massive bearish divergence. Now, that does not mean that the price can't continue to climb, but as the price goes higher and as the RSI continues to make new higher lows, or lower highs, I should say, okay, at some point in time, you're going to experience a crazy bear trap where the market pumps above a previous high and then breaks down, and that will be the all-time high. And so you want to prep by being very cautious into some of these moves. If I start to see this type of price action on something like the S&P 500, then I am likely going to be out of virtually all of my risk on assets, and that would include crypto. So we're nearing that make it or break it time. And ultimately, this previous little Bitcoin dump doesn't worry me terribly much right now, right? Obviously, this dump was pretty tremendous in the crypto and Bitcoin market, and then this sell-off for a bearish engulfing candle doesn't really help me feel confident or comfortable. I mean, this is really Bitcoin's last stand, if you will, at the 66.5 range to stay above that $67,000 support range. And if it starts to break down, that might be a little bit scary. And it also doesn't help that consistently we're seeing more volume and selling in terms of these big boys, okay, in red volume candles than we are seeing in terms of the green buying candles. Okay, so the volume is only confirming that a lot of people are starting to get worried and nervous here. Now, ultimately, I'm gonna hold my positions right now, and that would mainly be because I just don't feel like the market is done completely yet, and it's better for me to hold this position with a bit of courage than to just sell the moment I start to get a little bit fearful. And so if I pull up an anchored VWAP from this major low, okay, which is a volume weighted moving average, you can still see we are well above, not well, but just above this VWAP. So ultimately, we are still trading in a healthier range. We're developing a lot of support here. If I pull up that VRVP, you can still see that we had tons and tons of trade volume here. And so our next major cliff and low would be around 62,900. But I don't know if we're going to get there. If we did, it would be very unexpected volatility, but by this point I would likely be out. I will be getting out somewhere in the $65,000 to $64,000 range if that happens. And if the market breaks down and then breaks right back into my range, I'm totally fine taking a small loss to potentially protect against a major loss, and then to re-enter if the market entered right back into the $60,000, $7,000 range with all my positions back into these moves. Then I would be just taking a massive fat loss, because I said, well, I didn't want to be wrong for a moment and lose, you know, what could be a couple grand versus 100 grand. So it's really important that you practice good risk management in this type of an environment and market, and pay attention. Okay, if the S&P 500 continues to climb while the dollar index also continues to climb, and they start to stay positively correlated, something is terribly off, and it's likely the S&P 500, which means most markets are far more likely to collapse. So tell me what your thoughts are after having watched this video. What do you think is going to happen in the market? Are you watching any indicators that we haven't been noticing or seeing? And if so, share them in the comments below. But thanks so much for watching this video, and I hope to see you in the next video.